the webinar, if you would like to ask David any questions of anything that he's speaking about or anything economics in general, then just please type it on the right-hand side. There's a widget in your screen, so please just write your question, and then he can answer it. So I'm sure you all know David, but just to start today, we'll be going through an international market outlook, then focusing a little bit more on the domestic Australian market and an outlook there, and then just a few ideas from David to see how you may consider for your portfolio. Without further ado, I'll hand it over to David. Welcome, David.
Thanks very much, Sarah, and thank you everyone for joining us again for the quarterly presentation. Now, just see if I can move this. Can I do that? Yeah. Or are you doing that? Okay, yeah, so we'll start off with the international market outlook, and look, the first port of call is the so-called global PMI index. It's an index of activity covering both the services and manufacturing sector. And the good news there is it's held up pretty well over recent months. In the latest reading for April is at 54, down a touch from its recent high 54.8 in January, but still holding up at pretty good levels despite all the various sort of risk factors out there in terms of Donald Trump and Korea and trade fears and whatnot. So sentiment globally is still holding up pretty well and consistent with the IMF forecast of close to something like 4% growth globally in 2018 and 2019, which is pretty good. Now, in terms of other key developments, if you want to flick to the next chart, I get the look. If those that were with us a few months ago, you may recall we did have a wage scare in the US back in January. The average hourly earnings measure seemed to pick up quite strongly to about 2.9%. Look, we do want to see wages growth in the US as in Australia lifting, but we want it to be sort of gradual. Now, what we've seen over the last few months is that wages basically in the US, as you can see from that chart, have actually remained fairly steady. So the annual growth is still held around 2.6, 2.7%. So the sort of scare we had with regard to wages, sort of accelerating, getting out of hand quickly in the US, has dampened down somewhat. Meanwhile, the labour market in the US has continued to tighten. So the unemployment rate now has dipped below 4%. It's now 3.8%. And so again, this probably remains one of the key, issues for markets over the coming year is whether or not wage inflation in the US will start to lift, and will it lift in an aggressive way, such that the Fed would need to be more aggressive in terms of raising interest rates. Provided it gradually moves higher, that's what we'd like to see. And again, so this is one of those charts I'll continue to watch very closely over coming months. The other issue globally is the US inflation outlook. So very long run, obviously the wages are part of it, but things like oil prices and profit margins and whatnot also affect, and healthcare costs and whatnot affect inflation more broadly. As you can see from this chart, and if you look in the last few months, inflation was averaging below 2%, but I guess over the past 6 months or so, it has crept back up toward that 2% level. So the Fed's target is for this US consumption deflator to basically, ideally they want it to be around about 2%. It's now crept up to 1.8%, but again, still fairly contained. Another measure of inflation is the consumer price index, something that the Fed looks at as well, but that's actually a little bit high. It's about 2.1% at the moment. But at the moment, things are still looking okay on the inflation front. It's crept up to where the Fed would like. And look, and my view is, if you look historically, it's really been much above 2% over the past couple of decades, and I don't really see a reason for that to sort of change anytime soon. Meanwhile, so what has that meant for financial markets? Well, the first key issue is that US bond yields. So this is a graph of US 10-year bond yields. As you can see, they've been rising in fits and starts pretty much since 2016, mid-2016. They did bottom at around 1.5, 1.4% back in 2016. Now they're starting to threaten the 3% level. They did break above 3% a month or so ago, and as you can see from the chart, they did then drop back, but now knocking on the door of 3% again. In fact, overnight, back at 2.97%, with the Federal Reserve. Just on that, I mean, the US Fed did raise interest rates as widely expected last night. It was slightly more hawkish than the markets and even myself were anticipating, because the Fed have effectively penciled in 2 further rate rises for this year, whereas previously they were only talking about 1 further rate rise. So likely to see another rate rise from the US in September, and then at the moment another one in December. The markets are basically seeing that as more likely than not. And, given the ongoing strength in the economy, it's not an unreasonable expectation that Fed may do that. So I think, bond yields will continue to go higher. As you'll see a bit later, my target is that in the US they'll hit 3.25% by year end. And that's going to put downward pressure on equity valuations. And one of the reasons the US market, I think, is, they're going to see more muted gains over the next little while. But the big positive for the markets remains earnings. So again, another chart that I continue to watch closely is the US earnings outlook. The black line there is what's called forward earnings, and it's like a weighted average measure of expected earnings for this year and the subsequent and next year. And as you can see, earnings growth is actually expected level of earnings for both this year, 2019 and 2020, have been creeping higher in the last few months. And that's consistent with that black line continuing to push higher. So something like, 10 or so % growth in earnings on a 12-month basis. So that is, the key, key support for the markets, while interest rates, meanwhile, grinding higher and putting downward pressure on values. So just on the US equity market valuations, again, another favourite chart of mine. And you can see as at end of May, the PE ratio in the US was around about 16.5. So this is a price to earnings ratio. And given that bond yields were around about 2.75% or so, that was actually pretty fair value. So the market, to my mind, as at end May, was reasonable value. Bond yields have crept up a little bit since, and in fact overnight, as I mentioned, 2.97%. Now, fair value, basically, what's fair value? I mean, I've put a line of best fit through monthly data going back over 40 years, and that would say fair value would be around about 16.4. I've got there, or 16.5, which is a little bit less than where it currently is, about 16.8. So market just a little bit pricey, just a little bit relative to what the fair value would be. But you'd say the market is, I guess, fully valued, given current interest rates. So not a lot of margin there, for PE ratios to go up much further from here, particularly given that interest rates, I think, are going to continue to edge higher. But again, at least the good news is that it's not grossly overvalued. It's like fairly fully valued at the moment. The other global development of late, which I should talk about, has obviously been developments in Italy. This chart here is basically the Italian versus German 2-year government bond yield. And so what that shows you is the risk associated with investing in Italian debt. And in that also is the risk of Italy, potentially leaving the Eurozone and, issuing its own bonds and potentially defaulting on its debt because it's got a, relatively large budget deficit and high amounts of debt. So as you can see, with the new government that came into power a month or so ago, bond yields did spike up because one of those parties was considered to be anti, staying in the EU, and also they did want to run, basically increase welfare spending at a time when the budget deficit is already pretty high. More recently, basically what we've seen since is that they have formed a government, but they are pledging to basically stay in the EU. So no one in government is wanting to leave the EU. So I think, you know, fears of that happening, which I think were always overblown, have basically been dissipated somewhat. Just on that, I mean, Italy still, I mean, the way I see it is Italy is a problem for Europe, a headache for Europe, but not necessarily for global markets. Provided that Italy stays within the EU, then it's not going to have major global ramifications. But what Italy basically want to do is run up a large budget deficit, and which is, you know, in breach of the sort of the monetary rules within Europe. You know, countries are supposed to have a deficit below 3% and debt below a certain level. So that is a debate and that will need to go on within Europe, and we'll see how that plays out. But I think as an issue for financial markets globally, provided that, you know, membership of the EU is not at risk, it's likely to die down as an issue. Interestingly enough, it could cause the euro, it further supports the idea that the euro exchange rate itself could continue to, I think, possibly weaken against the US dollar. A, because interest rates in the US are rising, the US economy is pretty strong, but also, you know, lingering argy-bargy between Italy and the rest of the European members could weaken the euro, which, funnily enough, could actually help the European stock market, as I'll talk about it a bit later. The other issue, Donald Trump trade wars, and I thought this was an interesting chart that was in the Reserve Bank's quarterly statement of monetary policy that came out in May, and it just shows you the situation of countries vis-a-vis the US in terms of their trade balances. So as you can see, so basically those dot line, the dots in that line are the net trade position of countries vis-a-vis the US. So Mexico at the top there, obviously a very big trading partner with the US. The share of Mexican GDP that is imports and exports from the US are quite large, and on balance it runs a surplus with the United States, as does Europe, as does China, as does Japan. So this is, I guess, what, you know, the US or Donald Trump is you know, complaining about, that they run persistent deficits. Just looking at it, if you look at Australia actually runs a budget deficit with the US. So, you know, we're probably the last country it should be complaining about, because we actually import more from the US than we export. And if you look at Canada, which has obviously been in the headlines lately, it actually runs a pretty much close to balanced position with the US. So it doesn't run a large budget trade surplus with the US at all. But anyway, look, that will, I guess, continue to simmer. But I don't really see it escalating in a major way to sort of derail global markets. It's something to watch, but I think at the end of the day, there won't be, you know, further major escalation. Though, you know, Trump is now talking about imposing tariffs on China. China are promising to import more from the US. So we'll see how that all pans out. But obviously, it's a risk factor. But again, I don't see it as necessarily a red rag for markets at the moment. So where are we in terms of global markets? So this is a chart of the US S&P 500 index. As you can see, the market peaked back in late January. It actually peaked on Australia Day, January 26th. We've been in this corrective phase for a while. The markets have basically, the US market has recovered probably 2/3 of that loss. And is starting to, you know, threaten the 2800 level. So the markets have recovered, not fully recovered their levels, but nonetheless, recovery is underway. And I think that recovery will continue. But, you know, the US market itself will be challenged increasingly over the coming year as interest rates rise. And I think a bear market will be avoided. But, I mean, what we may well see in the US is that as the market starts to move possibly sideways, around the 2800 level or so over the next, you know, 6 months to a year, but just because of that, the offsetting effects of rising interest rates on the one hand and downward pressure on valuations, and rising earnings on the other hand. And just to go through some of the numbers on that, so here's some of my projections really for the US market. And again, I focus on the US market here because it is the most important market globally. So if the US market is overvalued and it's going to have a major downturn, it's usually going to drag most of the other markets around the world, including Australia, down with it. And if it's holding up, that bodes well for other markets. So that's why I kind of focus on it in terms of projections. And as you can see, as of yesterday, that was the situation. Bond yields near 3%, PE ratio about 16.8. So I see bond yields rising. So let's 3.25% by year end, which should drag down the PE ratio. So fair value for the US market with that level of interest rates would be a PE ratio of 16. Meanwhile, earnings growth rising. So net, you're going to get a small further gain in the S&P 500. And then in 2019, again, at this stage, it looks like further small gains with earnings growth rising, but valuations coming off just a little bit. So again, from a global market perspective, we are looking at a maturing of the US expansion, but provided the inflation remains under control, the rate rises are gradual. There's no necessarily red rag here for the markets to pull back in a major way. What about the Australian market? So let me talk about the economy first. And this is just a chart of GDP growth. As you can see, we did get a good GDP number last week. The quarterly number was 1%. So the economy grew by 1% in the March quarter, and it pushed up annual growth, or year-on-year growth, to about 3.1%. And that was after a couple of quarters of pretty weak growth of around about 0.5%. So now whether that lasts or not, is obviously the big question. That the RBA has got growth strengthening a bit further to about 3.25% by year end. I'm still not as bullish. I think growth is going to come back a little bit just in terms of the economy. But let's go through some of the drivers of the economy at the moment. So firstly, if you look at business confidence, so the National Australia Bank survey of business conditions, and again the top by states, you can see what's been happening is overall confidence, overall business conditions are pretty good levels. The non-mining states have been holding at pretty good levels for the past few years, and particularly New South Wales and Victoria. But as you can see in that orange line there, over the past year, Queensland and WA conditions have also started to improve. You've had a bottoming out of mining investment that's been declining for a number of years. Plus, you've had a nice rebound in iron ore prices, and export volumes also starting to pick up. So conditions there, starting to improve. At the sector level, you can see the goods-related areas have been particularly strong. So this is construction. One of the big drivers of growth at the moment is construction. Both housing construction remains at a high level. Infrastructure spending by governments on things like the NBN, road and light rail projects, defence projects in South Australia, all these things remaining at high levels, and even public demand, things like the National Disability Insurance Scheme that's rolling out, seeing a big increase in spending by the government there, and it's helping underpin strong growth and employment in the care sector. So so again, a diverse range of drivers there. Looking at some of those sectors in more detail, this is a chart of building approvals, so home building approvals. And look, we've been waiting for this to turn down for a while, and as you can see, it looked like it was starting to turn down, but a couple of years ago, and then it bounced back through 2017. As a contributor to growth, it is waning, but overall activity is still at a high level, and it's the tradie-led economic boom, as it's saying, because home building, certainly high-rise apartment building across Sydney, Melbourne, and Brisbane still remain at pretty high levels. But the challenge for the economy is that this will eventually turn down. We are seeing a waning in housing demand from the housing finance figures. There are reports of off the plan property prices falling in some areas, particularly quite sharply. And so the market is trying to digest the supply that's coming. Now, that leads me to I guess the biggest drag on the economy, or the biggest question mark, is consumer spending. Just a chart there, as you can see, consumer spending has been holding up at around about a 2.5–3% pace over the last year or so, which is even stronger than incomes growth. Incomes growth, disposable income, has been even weaker, and so households have been supporting spending by running down the saving rate, basically. When consumer spending is running faster than incomes growth, the saving rate tends to decline. It's been pretty patchy. Like the last quarter's number wasn't bad, but the previous few quarters has been quite soft. So overall, it's still, you know, holding back the economy, running around about a 2.5, 2.75% pace. And that is the big question mark, is whether or not that will hold up. It's unlikely to accelerate a lot more. I don't see it. The fear is that maybe it slows down even further. Now, one of the issues for that is, as I mentioned, housing before. Just an update on the house price situation. So this is the CoreLogic monthly house price index nationwide. As you can see, house prices have been falling for a number of months now, particularly largely driven by the Sydney market. Property prices in most other states are still holding up. They are starting to weaken or flatten out, at least in Melbourne. But it's still the Sydney market which is, you know, the main drag on property prices at the moment. So the Sydney market is off something like 4% or so from its peak levels of mid last year. And again, my expectation is that will continue. I think property prices in Sydney will continue to drop, possibly up to 10% over the next year to 18 months. But it's really basically a slow unwind, rather than a crash that's occurring. And the property markets elsewhere around the country, no reason for a major house price decline, because they haven't really had much of a boom. So I think conditions over most other markets, apart from, say, Melbourne, should be fairly stable. The one standout state is Hobart. So you're seeing big, strong gains in Hobart property prices, and part of that is basically, it seems to be a flow of, you know, people from New South Wales are moving to cheaper prices in Hobart, and basically investors around the country also looking at Hobart as a cheaper option and bailing out of the Sydney market. So that's had particularly good price gains of late. Unemployment rate. Look, I actually had there that the unemployment rate was no longer, I mean, what we've seen of late, employment growth has been strong for pretty much the past couple of years. It has started to slow a little in the last few months, and in fact the unemployment rate had begun to edge higher. It touched 5.4% late last year. It ticked up to 5.6% most recently, but I can inform you that the labour force survey for May that came out about half an hour ago had the unemployment rate drop back down to 5.4%. So a pretty good result there. So that uptrend is well, we'll see if it lasts, but certainly the last reading on unemployment was good. It suggests it's ticked back down to 5.4%. But again, have to wait and see. That the RBA is hoping that it continues to trend down toward 5%. I think it will trend down, but not as fast. I've got the unemployment rate basically hitting 5, and you know, but basically I actually do have it going up a little bit this year, but then trending back down next year. But overall, I don't think it's going to trend down as much as what the RBA expect, and given that growth is going to remain pretty soft. In terms of what about the share market? So what's happening on the share market? Again, a bit like in the US, we've actually had a nice upturn in earnings growth in Australia. The dashed line there is forward earnings. It's been largely driven by the resources sector. Again, in the US, it's been largely, well, I guess it has a more diverse range of drivers there, the financials, technology, consumer stocks. In Australia, it's been largely the resources, but given the upturn in iron ore prices of late. And, you know, I think you can still get further gains in earnings based on current expectations, and I think earnings expectations will hold up. But again, you're not probably unlikely to get a stronger gain in earnings in Australia as you will get in the United States. But having said that, there are some, I'll talk about our market a bit later, but there are some positive features for our market vis-a-vis the US market, despite what I think is probably a softer earnings outlook. Let me talk about the valuations. So firstly, again, like the US market, the equity valuations in Australia aren't that bad. As at end May, it was around about 15.5 times earnings, so a little bit lower than the US. And at the moment, the Australian government bond yield is about 2.77%, so actually 20.2% less than the US yield. And at that value, my broad valuation framework suggests, a fair value close to around about 16. So at the moment, if you look at the current level of earnings and where the market is today, the PE ratio is about 15.2. So the market, would you believe, is actually a little bit cheap, given what fair value would suggest, given the current level of bond yields. Looking at our market itself, so the next chart will have the ASX 200. And as you can see, we didn't fall as much as the US did over recent months, and we've rebounded pretty well since. In fact, so there's actually been a little bit of outperformance of our market since the downturn in global markets since late January, and we're basically looking to hold above that 6,000 level at the moment. We actually almost surpassed our previous highs back in January. We've come back a little bit, but the outlook at the moment is it's still trying to reach new highs, or get back through the highs in January. And again, I think that's possible, as I'll show you in a minute. Just in terms of economic growth forecast, so again, I think our share market is looking okay, despite the fact that I think GDP numbers could still disappoint a little bit. But at least the good news for the market is it's going to emphasise the fact that the RBA is unlikely to raise interest rates anytime soon. So low interest rates are going to help support our equity market. So I've got growth a little bit weaker than the RBA, 2.75%. And the main driver there is, I think, consumer spending, wages growth. That part of our economy is going to continue to disappoint and hold back growth. And also, I think see a bit more of an unwind in the housing investment than maybe the RBA is expecting. Underlying inflation also a little bit less. The unemployment rate grinding up. I mean, on the back of today's numbers, I might need to rethink that 5.7. We'll have to wait and see. I think that the drop back in the unemployment rate today, it was particularly good news. But broadly, I think the unemployment rate's likely to go sideways rather than go down in a major way. But the RBA essentially on hold for the rest of this year and into the early part of next year, and really the first rate rise that is possible, I think, in the economy at this stage would be not until the second half of next year. And in fact, the speech by Governor Lowe overnight really reiterated the idea that they see rates on hold for the foreseeable future. And the reason there is that unemployment's still a bit higher than we would like, inflation still sub 2%, and wages growth still not picking up in a major way, so they can afford to keep rates on hold. Now, what does that mean for the market? Got some forecasts there for you. So again, look at our 10-year bond yield. At the moment, it's 20 basis points below the US. If the US bond yield ticks up to 3.25% by year end, I think our spread can narrow a bit further, or go further into the negative. So our yields will rise as well, but not as much as in the US. And then rise a bit further next year as we start to talk about the RBA raising rates. But meanwhile, what you can see is the actual valuations for our market. I've got a year-end number of about 15.8 for the PE ratio versus 15.2 today. So that valuations can actually support the market over this period. Meanwhile, earnings growth rising. Again, not as much as in the US, but still not bad. And net, our market can actually push higher based on these projections by year end. And in terms of the Aussie dollar, I mean, I think it's basically trending down. I think it's had an important break lower of late. The Fed continuing to raise rates is going to put pressure on that interest differential, and I think iron ore prices have started are continuing to remain, I think, soft, and that's going to support the Aussie dollar weakening a bit further. But just to emphasise, the issue here is that interest rates in Australia aren't rising as much as they are in the US, and our market is, has actually got some valuation margin there to improve. So that is, I guess, a difference with the US at the moment. So what about some favoured investment ideas? So just conclude with this section. First and foremost, this has been a favourite one of mine for the past year or so, and it still remains, I think, pretty good. So I focus on the S&P 500, but the NASDAQ, which is another index in the US, has actually retouched record highs of late, so it's bounced back particularly well. And again, the outlook there is still pretty good. The earnings outlook for the major tech companies in the US is still pretty solid. Valuation's still not that bad, around 20 times earnings. I don't see the regulatory issues surrounding Facebook as being, a game changer in terms of their, dominance of the, targeted ad market, and also in the case of Google. And you've got the other groups like Netflix, Amazon, all still posting pretty good, and Apple, all posting pretty good results. So, I still like the NASDAQ as a key global exposure, which you can easily obtain on the ASX through our ETF NDQ. So just one to bear in mind. Some other ideas out there given the current global situation. Firstly, we have a number of different global sector ETFs, of which one is global banks, the code there BNKS, and another one is Fuel, F-U-E-L. And so banks is global, obviously global banks, as I've said. Covering Europe, United States, Japan in particular. And fuel is the top global oil producers, essentially, or energy producers around the world. And as you can see, banks, the thing about banks, they tend to outperform when bond yields are rising. They've actually underperformed a little bit with the sell-off of late, which I think is a little bit overdone, as you can see from that chart. So that orange line there is the relative performance of the banks index vis-a-vis the world MSCI. So they've underperformed, even though bond yields have continued to push higher, or they are pushing higher again. So I actually think that underperformance is a bit overdone, and it's probably likely to turn around. So it's something a sector I think should do well in a rising bond yield environment. The other one, obviously, is a factor of oil, a driver of oil. So West Texas, basically the two measures of oil, the Brent crude measure, which is a more global measure of oil prices. The West Texas is a more, I guess, a US-centric measure of oil price. Both of them have been rising. As you can see, fuel has been started to lift on the back of that. Probably hasn't lifted as much as one would expect given the rise in oil prices. Now, I actually think oil prices are probably unlikely to, there is a risk that they continue to rise from here. Global demand for fuel is pretty solid. OPEC is still debating whether or not they're going to increase production again. And the US market, which usually production is rising in the US, but due to infrastructure constraints, they're actually not managing to supply global markets as easily as they would like. So it has created a bit of a shortage globally in terms of oil. So there is a risk that oil prices keep going up, in which case the fuel index, I think, will do well. But even if oil prices level out and go sideways from here, I think the earnings outlook for those companies is still pretty good with oil prices around current levels. So it's another index to think about. On a regional basis, Europe and Japan, and this is basically a play on the US dollar. And I think the US dollar is generally going to remain firm. And again, just reiterating that the Fed is raising rates. ECB is unlikely to raise rates anytime soon. We'll find out tomorrow whether they, at the moment, they've still got rates, near zero, and they are buying up bonds, and Japan is doing the same. Europe is talking about scaling back its bond buying program, but again, it's only basically talking about reducing the amount of bonds that it's buying. They're certainly not talking about raising interest rates. And in Japan, interest rates are on hold, near zero for the foreseeable future. So all that does suggest to me the US dollar should strengthen, which does tend to help the European and Japanese markets outperform globally in that environment. So two regional exposures to think about. So we have two ETFs there. HEUR covers Europe, HEUR, and then for Japanese equities, HJPN are the two. So they are the two ETFs should you be interested in exposure in those markets. In terms of our market, I mean, notwithstanding the fact look, the outlook I think it's not that bad, but at a sector level, we do have a couple of challenges. So the charts I've got there are basically the resources index. So again, we have two ETFs that cover the resources sector, the ASX 200 Resources Index, QRE, and we have one that covers the financial sector, the ASX 200 Financials, which is largely the banks and the insurance companies, and that is QFN. And as you can see, the relative performance of those two sectors vis-a-vis the market has diverged significantly over the past year. So resources have continued to outperform, even though iron ore prices, funnily enough, have actually been tracking sideways over that period. But the lift in iron ore prices over 2016 or so has helped lift their earnings over the past year, and so it's helped the resources sector. But also, I think you've just seen a switch out of the financials, which have had a world of pain given the, particularly most recently, the Royal Commission, the revelations coming out of that, the slowing in the housing sector, particularly in Sydney, and the tightening in credit conditions. So the financials have really underperformed of late. But I think both of those markets, I'm still a little bit dubious about whether resources can continue to do well, given that I think iron ore prices are unlikely to rebound in a big way. And the financial sector, look, it's starting to look cheap, but it faces a lot of regulatory risk arising out of the Royal Commission. So, it could be catching a falling knife in terms of, jumping into that market at the moment, or jumping into that sector. But one option to consider is going to like the smaller to the mid-cap part of the market. I just wanted to show you a chart here of, look, over the past year, the ASX is up 9.6%. But some of the smaller to mid-cap areas have actually done even better. So we have an ETF that tracks the top 200 companies less the top 20. So it's basically the X20 index. And that's up 14% over the past year, and has actually showed pretty good outperformance over the last few years. And we also have a small caps ETF, SMLL is the code, and that's up something like 18% over the past year. The smaller end of the market has been doing particularly well of late, and again, I think that could be a theme that will persist for a while longer. The other option in Australia, again, I just highlight this because we do have a widening range of fixed income or bond type exposures for those that are wanting relatively defensive exposure in their market, in the market. Firstly, I'll mention WIMAX. So WIMAX is a covered, it's an equity exposure, but it basically sells calls against the market and picks up yield income as a result, or option premium income. It means that the capital growth in that is generally not as strong as the market itself, because if the market rallies strongly, you don't get all of that upside, but you do pick up nice income from from having sold calls. And get extra income. So the 12-month income yield on that has been 9%, grossed up for franking about 11%. So good income opportunity. If you want more information on exactly that strategy, I've only touched on it lightly because I have mentioned a lot in past seminars. Definitely go to our website and look up WIMAX. QFN, like the financials, the price performance of the financials index has not been great, but it's still punching out pretty good income yield, dividend yields. So grossed up yield over the past 12 months of 5.7%. The ones I want to highlight, AAA is our cash product. So basically it's the ETF that invests in bank deposits, at call and term deposits. It's giving you a yield of around about 2%, which is very competitive with term deposits. But the ones I also wanted to highlight are our floating rate note ETF, coupon. Hybrids, so we have an ETF that tracks bank hybrids, or basically hybrids, not just bank hybrids, but the hybrid market in particular, and a new ETF which covers corporate bonds, and particularly longer dated corporate bonds at the 5 to 10 year part of the market, and that gives you a pretty good income of around about 4% or so. Just to talk about, and again, if you're interested in any of those products, definitely go to our website. We've done a lot of I've written a lot of blogs about all of these different ETFs. If you want more information, but in the interest of time, I won't spend too much longer on them. But one I do want to highlight is CRED, which we just launched last week. And I said it's a corporate bond index. So as it's corporate bonds and not government bonds, it will give you a higher yield than government bonds. And also because we basically invest in longer dated bonds, so those of a 5 to 10 year maturity, you also get an extra yield as a result. Now the beauty of owning longer dated bonds is that they're more sensitive to interest rates. So as interest rates rise, it tends to underperform a little bit relative to like shorter dated bonds, and vice versa. When interest rates decline, it tends to outperform. Now, what that means is that within a diversified portfolio, if you're holding this alongside equities in a risk-off environment where equities fall and interest rates fall, then you're likely to get a bigger, upside by holding something like CRED. And so we've run some numbers there, and the last column I want to highlight there. If you had held this ETF 50% weight with a 50% weight to the ASX 200 and held it from February 2008 up until April, so including the GFC, the downside of that portfolio, so the drawdown, would have been about 15.6%, which is actually comparable to what you would have had. It was actually a little bit less than some of the more popular, or I guess more better known corporate bond indexes in Australia, the Australian Composite Bond Index and even the Corporate Bond Index. But note, so for the same downside protection, you're getting a much better yield. So something like 4.8% as a prospective income yield on CRED over the next 12 months versus only 3.2% for the Composite Bond Index. So as a source of portfolio diversification, it's pretty good, and it gives you a good yield in the meantime. So again, get a lot more information on our website if that's of interest, and I'll leave it at that. And so really that concludes today's presentation. Hopefully you've got something out of that, and I'm happy to take some questions.
Yep. Okay. Thank you. Thanks, David. It's always great when an economist makes some predictions and forecasts. So always good to hear. So now that we've sort of heard your commentary and some mixed reviews, we've just got a poll for everyone, and the two biggest sectors, and you did speak a bit about the financial sector and the resources sector. So given the performance of both sectors, we're keen to hear from the audience. Do you favour investing in either the banks or the resources over the sort of, would you say near term or mid term?
I'd say 6 months to a year.
Yeah. So.
Or which do you reckon is going to do well?
Well, I mean, that's a different question, but yeah, absolutely. So let's have a look. And so we saw some great responses. Oh, I'm sorry. I think I just killed the screen there, so I apologise for that. Some mixed responses there, but most people saying that they would invest in neither. So, so people keeping their money firmly in their pockets. Now, just to answer some questions, you did speak a bit about the financial and resources sector, as I said, and your valuations for the S&P, for the Australian market. What have you factored in for bank share prices in that time, or do you want to comment on that?
I guess implicitly in my forecast that bank share prices will recover somewhat here. They've been sold down, and the valuations they've certainly cheapened up. I mean, as you can see from the market itself, the market is trading at a P/E ratio of 15.2. So yes, I think banks can recover somewhat as the Royal Commission revelations start to fade from memory. I mean, the risk here is, of course, what they, they potentially face new regulatory issues, but on the other hand, I mean, it could end up that banks actually have a stronger position coming out of all this, depending on what they do in terms of brokers and if the home loan broking channel is somewhat reduced and they have a stronger part of that market. I mean, if it means that banks get out of wealth management and financial planning, which is, I guess, at the end of the day, not been a great source of revenue for them, they could actually come, have a simpler business and a stronger, more dominant part of the home loan market. So it's not immediately clear they're going to be, devastated by the Royal Commission.
And just an earlier question about, I guess, where the market is going. And Ross has said that he's seen some commenters saying a 20% correction coming. And your view tends to be a little bit more sideways at the moment. It's probably fair. What's your view on that 20% correction?
Look, I mean, you definitely can't rule it out. I mean, we've got the Fed raising interest. I mean, it gets back to the idea of, how aggressive will the Fed be in terms of raising rates? That is the bottom line. Now, if inflation, I mean, something like a 20 or, basically a bear market, a 20% correction is entirely possible if US inflation, if wage inflation starts to spike higher in a big way. As I've shown in my chart, so far it hasn't. And there's a lot of, and in fact, around the world, you've seen that wages and prices have remained pretty well contained despite tightening labour markets. But so that I'm going to basically that's still my base case, that inflation and wages are going to remain reasonably well contained. As a result, the Fed will basically only do what it's promising to do. At the moment, the Fed is saying it's going to raise rates now twice more this year. On those numbers, I think 10-year bond yields can get to 3.25%. So yes, they'll gradually grind higher and they'll gradually cause the PE ratio to come off a bit, but earnings growth more than offsetting that. But it all gets back to that inflation story, and those calling for a bigger correction, I think, are implicitly assuming that wages and/or prices in the US are going to pick up in a bigger way than I'm expecting.
And how do you see the increase in global debt likely to pan out over the next 12 to 24 months? That's a question from Steve.
Look, I guess I asked about global debt a lot, and look, at the end of the day, the debt that exists in different countries is there for different reasons. So, for example, in China, a lot of the debt is basically state-owned enterprise debt, which essentially is, will be sheeted home back to the government should anything happen. In the US, you've got a big run-up in, I guess, in federal debt now and the budget deficit. But look, I don't see signs that any of this is particularly unmanageable from a global perspective. And when you actually delve into the details and look at the specific situation in each country, I don't think there's a reason for that to cause undue concern. I mean, then you've got like emerging markets, Brazil, they all have their own issues and challenges, but in and of themselves, I don't think there'll be a cause for concern from the global perspective.
And there's actually been quite a few questions on Asia and emerging markets, and I guess any additional comments you had on those?
Yeah, look, emerging markets essentially tends to be a US dollar call. So when the US dollar is weak, it tends to support flows into emerging markets. It helps keep their interest rates down and their currencies firm. And when the US dollar tends to strengthen, they come under some pressure. So look, they've had a good run because the US dollar largely last year ended up being surprisingly soft. I think the US dollar is starting to firm up again, and as a result, I think the outperformance we've seen from emerging markets is likely to peter out. So as an overall investment theme or investment in you can invest in emerging markets through an ETF. We don't have one, but there are some out there, or invest in, you know, active funds that have emerging market exposures. But I think the outperformance run that they've had is going to wane as the US dollar strengthens.
And a question from Gerard, which is absolutely fantastic, because I know I've asked it myself before. There are so many ETFs on the market now, and BetaShares just launched our 46th fund with CRED. So with so many ETFs on the market, don't you think it gets just as confusing as buying individual shares?
No, well, in a way, well, yes and no. I mean, yeah, you can, if you want to be confused by the range out there, it's very easy to be confused. I mean, I guess the way to approach it is you can split up ETFs in terms of asset classes, so equity type exposures, bond exposures, currency exposures, and then within that, basically sectors or country type exposures. So whether you want to invest in resources versus financials, Europe versus the US, and then in bonds, you know, how much do you want to be in bonds versus equities, that sort of thing. So basically, we're providing the tools. So it's there's a lot more choices in terms of how to run a diversified portfolio using ETFs. Whereas obviously, if you just invest in individual shares, you're just getting equity exposure, and you're getting obviously company-specific risk, which is something that when you invest in a broader ETF, you diversify away from. And you know, and the thing about it is, you could be a great stock picker and you've got, you know, a portfolio of shares, but you know, when the market itself turns down, they're all likely to weaken because they all, end of the day, still quite highly correlated with the market overall. So, look, it obviously can get confusing. It can be confusing, but I would first approach it from, you know, what are my asset class exposures that I want? And again, if you don't want to go down the path of worrying about individual regions, you know, try to pick the best region or pick the best sector, you can just buy an ETF that tracks the overall market, you know, be it global markets or the Australian market. So it's really up to you in terms of how complicated you want to make it, or how easy you want to make it.
Good answer. Look, we've had so many questions and an absolutely outstanding participation and attendance today. So we will have to leave it there in the interest of time, but we do thank you for joining us at the quarterly outlook. And thank you, David. Always, your insights are always interesting, and you bring those charts to life. And we hope to see you at our next quarterly webinar. You will get an email later this afternoon with the presentation deck and a recording of this webinar. So we thank you very much.
Thanks a lot, everyone. See you next time.